One of the big features of the markets at the moment, and we're hearing it again and again, whether it be from corporates or from central banks or from governments, is that we should all be cognizant of the fact that inflation is rising pretty much across the Western world. And in fact, if you're in some of the emerging market economies, it's even worse off, as we see a continuation of the rise in raw material prices push out around the world. And the big question is, as traders and investors, how can we focus in on this and with some sort of precision work out a plan to benefit from these markets? Because there is an edge to take, and that edge can be seen, perhaps possibly maybe, when looking at commodities rather than any other area of the market. Well, let's dig a little bit deeper now in this and catch up with one of our regular guests here on IGTV. It's Simon Popple from the Brookfield Capital Intelligence Report. Simon, thanks indeed for your time. We've been talking a little bit about this leading up to this interview, talking about how we can make money in these environments. And one of the questions I want to ask you during the interview is how we can benefit. But let's just go back a little bit and talk a little bit more about what it is about this idea that inflation and commodities work together to give an opportunity for us in trying to make money.
Yeah, absolutely. Well, I mean, I think we can sort of break it down into different components. I mean, the first component is probably looking at, I think a lot of people are scared about a market correction, market crash, whatever term you want to use. And I think that, first of all, commodities, in particular gold, historically have actually performed quite well when there's been some market corrections. And so, obviously there's no perfect hedge from a market correction, but if you have a proportion of your portfolio in physical gold, sort of the actual COMEX gold, then if history was to repeat itself, you could be doing better than a lot of people.
Okay, well, talking about history, let's look back. I know you've got some charts where you can work out some comparisons. Give us some comparisons about where this strategy has worked before, and then we'll move on.
Yeah, I mean, as you can see, I've got three charts I really want to sort of canter through, but this is the Dow. But as you can see, the Dow has had, various corrections, and the COMEX has actually done reasonably well while there's been a correction. And obviously, we don't know what the future holds, but looking at the past, COMEX gold, where the Dow has taken a tumble, COMEX gold has actually done quite well. And so, for people who've perhaps got a lot of money in equities, then there may be some logic for having some of your capital in COMEX gold in case there's a correction.
You talk about gold, but in fact, my understanding is it is not just gold. It's also the entire commodity complex. We've got to be cognizant of the fact here that commodities are priced in dollars. So there's a lot of moving parts going on here. And I think we should get a better understanding as to the fact that, as I said, it's not just necessarily gold we should be looking at, is it?
Absolutely. I mean, I think you should be sort of leaning into inflation. And what I mean by that is, there's lots of different, moving parts to inflation, as you point out. And a lot of it is commodity based. A lot of commodities are going up in price. And, you need to look at yourself on a personal level. What are you actually consuming? Unless you're building a house, the lumber price isn't probably that relevant to you. But look at what commodities are relevant to you, and then that may be an area that you want to perhaps invest in. So when you're filling up your car with petrol or diesel, whatever it is, if obviously the price at the moment is going through the roof, but if you've invested in some oil and gas companies, then at least psychologically it might not be quite so painful.
But at the same time, as I said, because they're priced in dollars, there's a currency element going on here as well. For example, taking the point about gold, I think I'm right in saying, aren't I, that if you look at gold in Russian rubles, for example, gold's at a record high, isn't it? Because we've seen this crash in the ruble. But at the same time, here in the UK, if you buy gold, you've got to take your sterling, you've got to do the currency transaction before you buy gold. and there's a risk in that, there's a cost in that. But it doesn't matter if it doesn't happen to be just gold. It could be corn, it could be wheat, it could be cotton. They're all priced in dollars, so we've got a currency risk going on as well.
Absolutely. I mean, what I like about this is, commodities have got value wherever you are in the world. So, if you've got a bar of gold in China, Russia, Germany, wherever it is, it's got value. And as you say, it's the same for other commodities as well. So what I particularly like about this strategy is I think a lot of people have made money perhaps from property in the UK, in which case you've got huge exposure to sterling. Whereas if you've also got a portfolio of commodities, you've not only got diversification across different commodities, so gold, silver, cobalt, uranium, copper, lots and lots of different commodities. But you've also got some currency diversification, because the chances are that some of the companies that you're investing in that are closely correlated with that commodity are elsewhere. So you might have got some exposure to the Aussie dollar, Canadian dollar, US dollar, whatever it is. And so what I like from a personal perspective is diversification, not only in terms of commodities, but also different currencies.
Okay, well, let's take a look in that case at an opportunity to gauge on a chart as to how the commodity spectrum itself is doing. Because I know you've got a chart which shows what's happening with the Goldman Sachs Commodity Index, which gives an indication of past performance. Should we extrapolate from that as to what could happen?
Yeah, I mean, it's very difficult to say, because if you knew what was going to happen in the future, you'd be making an awful lot of money. But if you look at this chart from my own personal perspective, and this is a 25-year chart, so but if you look at where we are, I think a lot of people feel they've missed the commodity boat, but that may not be the case. And if it's not, as you can see, there could be an awful long way to go with commodities. Now, clearly, we don't know. Things can change, but all I would say is, looking at this chart, I think it makes sense to have, at least some of your portfolio exposed to commodity prices.
Let me ask you about the price of gold. Now, I know you're not a gold analyst, and you don't normally nail your colours to the mast that firmly to give me a price for gold, but clearly you've been talking about this on expectations, presumably that the price is going to rise from where we are. What are your feelings, or what are you looking at to give you an indication that gives you this expectation that gold is going to continue on what has been over the long term an upward trajectory, although it has to be said in the last 6, 8, 10, 12 months or so, it's underperforming its record highs that we saw last year?
Yeah, I mean, I tend to look at the fundamentals, and I mean, if you look at what's happening in the world with inflation, I know interest rates are going up, but one of the big negatives of gold is it doesn't yield anything. But what particularly scares me at the moment is, let's say you've got interest rates of 1.5%, 2%. I think inflation, the RPI in April was 9. There's talk of it being higher, perhaps 11. So if you put your money in the bank, I think you can get 1.5%. And if your personal RPI, personal is very important because everyone's got different levels of inflation depending on what they consume. But let's say it's 9. Off the bat, you're losing 7.5 in terms of purchasing power every year, unless your investments or your income is going up by that amount. So I think the gold price will improve. I'm very careful in terms of what where I say it's going to go, but I look at Incrementum, who published a report called In Gold We Trust, which is a very detailed report, and I think that their projections don't seem outrageous to me, and obviously they put a lot of thought and effort into them. And what I like about them is they're both comfortably ahead of where we are at the moment. So will we get there? I don't know, but I would like to have some money in the market in case we do.
Okay, that takes us round now to where we started the interview, and I said I was going to ask you about how to make money in these markets. At the Brookfield Capital Intelligence Report, what are you saying about the ways you should construct a portfolio to take advantage of this? You talk about COMEX gold. It's all very well owning gold, and as you said, it doesn't pay a dividend. You're subject to all sorts of other things. How much better is it to own, let's just say, a gold producer when prices are rising rather than the metal itself? Or do you go for something like coins, which don't attract stamp duty or capital gains duty rather? So where is the best money going in an environment like this, where according to your forecast and what you're picking up, we've got upside to gold to come and other commodities?
Yeah, I mean, I think you need a diverse portfolio, and I actually particularly like the mining companies, because then you can get a portfolio, as you say, you know, some are producers, some are explorers, everyone's looking for different commodities, so you can get a nice little basket of commodity companies. And if you've got a mixture of different commodities, some producers, some explorers, then if a commodity price takes off, you could do extraordinarily well. And another point that I'd mention is, given the world we live in, there's a lot of supply chain issues. And one of the great things about particularly gold and silver companies is a lot of the value is created at the site. And so, you know, discovering the gold is the first thing, and then processing it is the second thing. But you're probably creating 95% of the value in a very short area, and without the need to have long supply chains. Whereas if you've got a long supply chain where you've got to move a product around several different countries, you know, there's an adage, you know, you only need one missing component to stop a production line. And with gold, you've got a very short production line, and providing the price holds up and the costs remain, you know, more or less where they are relative to the price, you know, you can get some very nice dividends from gold companies as well. And I think dividends could be a challenge for certain companies where they've got long supply chains, and you know, they've got various disruptions in their supply chains.
Look, Simon, thanks so much indeed for joining us. Interesting subject on inflation and investing and trading around the commodities markets. That's Simon Popple from the Brookfield Capital Intelligence Report. And of course, if you do want some more information from Simon about that, you can join him on his website. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.